Hello, it's Jonathan Wellum of ROCKLINC Investment Partners, and I'm here with Jesse Vandermeer and Andrew Chang, and we're looking forward to our September webcast. And so we want to get right into it, and I'm going to share the screen now. Below you on the YouTube channel, you can find our presentation and download that. But so let me go to that right now, and I'll just share the screen here, and we'll get right into the presentation. Lots of things going on in the world, as we all know. So we've entitled this Focus on Valuations, and that's what we're going to have a little bit more emphasis on today, because we think that that's very important given the current market context. The disclaimer, look at that, please. That's just some important legal information for you to note. And let me just look quickly here at the outline of the presentation. I'm going to just say a couple things quickly about our investment philosophy, which is always important as a bedrock, investment challenges, the key issues that we see 2020 and beyond, and then talk a little bit about excessive valuations, just a couple of moments about our strategy and positioning, just to emphasize to our clients again how we're positioning. And then Jesse will speak about Wheaton Precious Metals, and Andrew will talk to the company CGI. And those are the two stock codes you see there on your screen. Okay, let's just jump right into it. In terms of a quick overview, how are we doing? This has been a very good year for us. We continue to grow, expand, adding new households as we go. And we're about 145 households and about $175 million in terms of assets under management. We continue to focus on being unique, differentiated, independent in our thinking, and we want to look at the world with a from a perspective of reality and not the typical sort of Bay Street or Wall Street approach. And then the last point there, just note on this slide, is that we have actually hired a new individual to join our team, Braden Van Dyke, who will be working in some of the administration areas and also interacting with clients and building client relationships. So we're very happy to add Braden to our team. He'll be starting next week. And that will, again, is just indicative of the growth of the company that we've been experiencing. In terms of our investment philosophy, as we emphasize on all of our presentations, we are buying very good companies. We focus our attention on a limited number of businesses. We like to compound for as long as possible, providing nothing has changed in the company or the valuation doesn't get too excessive, which we'll talk about. And then we want to purchase at a margin of safety, which means that we want to be very careful and sharp with the pencil in terms of what we're paying for businesses, and then understand the economic backdrop, which we'll speak just a little bit about that in this presentation. The investment challenges, these haven't changed since, we did the last webcast, and probably they haven't changed really for the last 10 years. These are major issues which continue to intensify. And so we're constantly concerned about these issues and how they impact our investing. So first of all, excessive global debt. I don't have to tell you that that is a major, major, major problem all around the world. It's only been made worse by locking down economies and spending money. Unfunded government promises, demographics, the aging of the population, real lack of family formation is becoming even more severe this year with the lockdowns. They're telling us that child births have just plummeted across most parts of the world. And we'll pay up for this. You don't have children, there is no future. And so you can't ultimately continue to function as a society unless there's a high level of births in the culture. Monetary policies we've talked about a lot, and we'll mention again here, there's a lot of printing money, record low interest rates, and this is again feeding a lot of movement in the stock market, feeding a lot of the price increases that we're seeing. And then this lockdown folly. I mentioned this in the last presentation that we did. I'm going to mention it again. I think this is the most devastating and costly mistake in the history of the world. We've never seen economies literally quarantine their healthy people and not focus rather on the sick people and how you protect those. And the economic cost is massive, and we're just really starting to see the impact of this, and it's going to take some time to run through the system. So don't be complacent. estimates of about 30 trillion in total global losses and capital formation destruction. When you look at the whole picture on a global perspective, the big numbers, they're really mind-numbing in some cases. Then I just put this up because the last time I put this graph up, or this chart, a lot of clients found it quite helpful. And this is just looking at Canada. It's updated as of September 11th, so this is very close to September 17th as we're presenting this. We've had about 9,163 deaths. They say 9,200 deaths. That's about 0.02% of the population. Is a very small number. You can also see, if you look down sort of midway in that inverted triangle, you can see that under deaths, about 85% of those deaths, 7,800, have been in long-term care facilities. So there's about 1,300 people that aren't in long-term care facilities that have succumbed to the coronavirus. So that's been, the key factor in terms of their death, as best as we can tell. Under the age of 20, there's virtually no deaths. We've had about 9 cases there. And so it's very low risk for children, very low risk for folks less than 40 years of age that don't have any morbidities. And so I point this out because we need to start, I think, pushing back on politicians who have just really taken over and taken way too many powers to themselves and really constrained our liberties and freedoms, and are having a devastating impact on the economy. Just for quick perspective, there are about 5,000 suicides a year typically in Canada, 5,000. We have traffic accidents of about 2,000 a year in Canada. Influenza and pneumonia, we generally run around 23 per 100,000 people, which basically works out to around 8,000 a year in typical influenza, and along with pneumonia. And so again, we're not shutting down the economies for that. 75,000 to 80,000 in cancer deaths a year, along with about 40,000 in heart disease. So we always need to put context on numbers. If you're just telling people every day how many people are dying from coronavirus, people get preoccupied with that. If you told them, for example, that we had 275 abortions every day in Canada, so that every 33 days we actually have killed 9,000 children in the mother's womb, just takes a little over a month. That would put some perspective on this also, if we really were concerned about human life. And so again, we want to have proper perspective and not be just given over to fear and politicians grabbing a lot of our freedom away. I think without proper justification. And so again, we point this out because this is becoming a very expensive proposition for all of the global economy, and especially for us here in Canada. So key issues, 2020 and beyond. Stock market valuations are high. We'll talk about that. The failure of monetary normalization, that means the failure of the central banks really to get back to any kind of normal state. We have unprecedented increase in debt levels. In Canada alone, $400 billion plus. We have a budget, or at least an update, coming down the pipe in Canada the next week, we're told. And they're talking about potentially $200 billion deficits over the next couple of years. So these numbers are staggering. They're completely unhinged from reality. And we need to really be pushing back against our government and our politicians who are just hell-bent on destroying the Canadian balance sheet, if you will. The debt-bearing capacity of governments is really maxed out. And you see that because on the 5th point here, that's why they're printing so much money. They really can't float this debt into a market and get people to buy it, so they just print the money, and that's what's supporting it. That's what we call monetizing your debts. The US, $120 billion a month they're running. We just heard that yesterday from the Federal Reserve. And in Canada, we're running $5 billion a week, which is about $20 billion a month. These are massive numbers, particularly on the back of the financial crisis that we had 10 years ago. We just keep adding more and more and more and more. Okay, let's just talk a little bit about valuations and why we want to be careful with your money. And why we keep a little bit back, why we have some cash, why we want to be very sensitive to this. On this chart, And I'm going to have a couple of charts here that will probably give you more information than you might want to see, but you can look at this at your leisure afterwards. This is a chart that clocks the total value of businesses in the United States, and it's looking at the Wilshire 5000. So it takes all, the top 5,000 publicly traded companies in the United States, adds up the total value of those companies, and it looks at them as a ratio of the total value of the economy, or the GDP. And so if you have 1-to-1, that means the value of the Wilshire 5000 or the big 5,000, publicly traded companies would be equal to the GDP. If you're above 1, that means you're starting to, the stock valuations are higher than the GDP. You go back to the dot-com bubble, you can see on that chart, we're about 1.37, which means we're 37% above the value of the GDP. The housing bubble, we reached about 1. You can see it's usually when it goes that high, it tends to fall quite a bit, below 1 down to maybe 0.8, 0.5. The housing bubble, we were at 1.05, and then it dropped all the way down to 0.5. We're now up to 1.5, as you can see there in the second quarter of 2020. This means that overall, and again, it's just an overall measure, stocks are expensive relative to the size of the economy. On the next chart, you can see that we're looking at price earnings ratios. And this is a very, again, quick way to look at valuation metrics. There's all sorts of adjustments sometimes you have to make. It's not the perfect measure, but it does give us a good indication. And you can see that in the orange, which is the Russell 2000. So we're looking at smaller value companies. That valuation, that price earnings ratio is very, very high. Partly because earnings have been constrained by the coronavirus, the lockdowns, but this is looking at the forward 2-year estimates, and it's pretty high, and 33 is very expensive overall as a measure. You can see on the S&P 500, which is in the blue, if you follow the dark blue, we're sitting well over 18, close to 19 times earnings, and that's looking at the forward 2-year estimates, and those are pretty, there's some rosy estimates there. People are looking at some pretty good growth over the next number of years, and whether that comes to fruition or not, of course, we want to be careful that we're not overpaying for it. And you can see that that's trading at, as I say, 19 times or so versus an average of about 15. So overall, again, a little bit expensive. We want to be careful. Now on this slide, this is, I find, very interesting slide. If you look at the concentration of the S&P 500 and you compare it to today, back to 1999 when we had the tech bubble, you can see back in 1999, the top 5 companies, Microsoft, GE, Cisco, Walmart, Exxon, were about 16.6% of the value of the S&P 500. That means 5 companies were worth 16.6%, and the other 495 companies were worth the remainder. So you have a high concentration. Well, in year 2020, that concentration is even greater. So the top 5 companies are 21.7% of the S&P 500. And the reason I point that out is that a lot of performance is coming from a limited number of companies. And so this has pushed the market up a fair bit. And if you look on the far right-hand side, year-to-date return, information technology, you can see it's done very well. It's sort of the tech space. You can see consumer services have been a little weaker. And then the bottom 3 sectors, industrials, of course that happens if you shut down the economy. You're not going to have a lot of industrial production. Financials have been weak, and energy. Again, energy has just come under a lot of pressure because you don't need as much energy if everyone's sitting at home. And so energy demand really plummeted and supply was excessive. And then that bottom little box there, you can see that the S&P 500 top 50, so these would be the big companies, they're positive this year, although the index is slightly negative, and this is to the end of June. But if you were to equally weight all 500 companies and you weren't giving bias to the large companies like Apple and Amazon and so on, actually the average company would be down 10.8%. So again, this points that there's valuation issues in some areas in terms of excess, and then there's other areas that are probably much more attractive, and that's where we got to try to focus our attention. So this, I put this chart up here, valuation comparison. We just took infrastructure companies where we have a heavy weight in, And we, going forward, we want to maintain a good heavyweight infrastructure because we think it's a very profitable area, very consistent area, good dividends, good growth, the mid to low double-digit growth over the next number of years. And then we compare that to some of the technology companies, which are growing, yes, more quickly, but not, maybe 1.5 times and, 50% more quickly, sometimes maybe twice as fast, but not any more than that. But you can see when you look at the multiples of the enterprise value, that's EV, that's the total value of the business, divided by the overall cash flow of the business, that in many cases you're paying, well, in Tesla's case, that's TSLA, Tesla on the technology side. Some of these stock codes you might not be as familiar with, but it's trading at 100 times. You can look at Netflix at 16 times and generating no free cash flow. NVIDIA, the bottom one there, NVDA, trading at about 67, 68 times. Yes, NVIDIA has growth, but it also has got a lot of challenges too. And right now it's in the sweet spot and people are just sort of bidding the price up. And so we want to be careful. If you look over on the infrastructure side, you can see a much more consistent level of numbers and ratios and valuations. And so for our point of view, we want to take what's much more dependable and what's producing consistent results and growing over time. And so again, we just put this up as a comparison for you. Year to date, as of September 11, you again get a certain measure of this. The NASDAQ's actually up like 20%, 21%. It is bouncing around a lot in the market currently. And so that is going to vary, but we're looking at 20%, the S&P up 3%, the Dow Jones down 3%, gold's up 28%. As we've been telling our investors, we like that space, and that's because when interest rates are super low or negative, and when they're printing money and these all sorts of economic risks out there, gold is a safe haven. The 10-year bond is down by 124 basis points. That's about 1.2%, which is a massive drop, which means, again, they're printing money and there's a lot of stress in the global economy. And oil, as we already talked about, has plummeted because of lack of demand. And just 2 more slides that I want to point your attention to. A lot of people ask, they say, Jonathan, people are at home, unemployment's up. Why are stocks going up? Like, what is going on here? How does this compute? And I say, well, in the short run, I can give you an answer. In the long run, if we have economic weakness, no, stocks can't continue to go up. But in the short run, this is what happens. You get economic weakness. You can see on the far left-hand side. Then you get fiscal expansion, which means government spends money. Fiscal policies, when the government spends money, big deficits. You get monetary easing. The central bank steps in and goes, hey, we're going to flush the system with more cash, print money, lower rates. What happens? Keep working your way over. You paper over some of the problems. People have money that the government's giving out so they can go and spend it. So it keeps businesses chugging along. You've got low costs of money. So interest rates drop. People go out and buy, houses. They go buy a whole bunch of things. They go to Home Depot to do alterations on their house and landscaping. And the next thing you know, you got higher valuations. The problem is that's not sustainable. Right, is as the economy comes back into balance, governments have to pull back, inflation starts to hit, interest rates have to go up, and we will have a stepping back at some point. And so we want to be careful. This chart here I find very, very instructive. I mean, it's really a powerful chart. And what it's doing is it's saying how much stimulus has gone into the various countries that are listed there. You can see Canada, our own countries on the far left. And you can see how much stimulus as a percentage of the GDP, the total value of the economy, has been pumped into the system. And if you look there on that far left-hand side, you can see under GFC, what does that mean? That's the global financial crisis. So that's the 2008, 2009 period. We had about a 4.6% of our GDP stimulus, very small. The Harper government was in very good shape. Canada was in very good shape, and we had very little excess sort of spending, if you will, or stimulus. We didn't need to have it. And you can see that the blue is the government portion. The orange color is the central bank, how much money they're pumping into the system. So those two work together. Again, the fiscal policy, monetary policy. So fast forward to today. If you look under the COVID-19, we've seen a stimulus that's equal, when you combine the fiscal and central bank stimulus, 41% of our GDP. I mean, this is shocking. I mean, these are numbers that you just don't see. You see occasionally if you're in the middle of a world war. Back in World War II, World War I, you saw massive numbers. But to fight a virus that has killed potentially 0.02% of your population is absolutely shocking. So you've got 41% pumped into the system, and that's going to get larger. In the US, it's over 44%. You can see in the Eurozone about 30%, in Japan and so forth. So look at that chart and you go, wow, this is the way we respond to a flu virus. Yes, it's highly contagious, but not overly mortal in terms of healthy people. And this should concern all of us. This is very expensive. So how do we position ourselves in a nutshell? As we've talked about this before, we do minimize financial institutions, a lot of leverage. We try to, again, stay away from economically sensitive commodities. So again, the oils and some of the commodities that require a very strong economy. We want to be, if we are in commodities, we want to be in commodities that are going to grow despite a slower economy. There's high demand for them. We're careful about consumer discretionary businesses because we think people are going to be under financial pressure for some time. We maintain good positions in precious metals, the gold and silver. These are a hedge really to low interest rates and excessive debt, money printing. We also want investments that give us exposure outside of Canada, because Canada is a very small part of the world, and we're facing some significant challenges in Canada as a result of the lack of leadership, especially at the political level across our country. And maintain equal weighting in core businesses with strong balance sheets, essential to the economy, and big moats. In other words, they have a substantial market position that's going to be hard to get rid of them. And then we maintain liquidity. And as we've talked to our clients, look, we think having some cash around is very valuable. It gives us tremendous optionality going forward. If the market's weak, then we can step in. And we want to be patient. We do not want to chase stocks. The last two slides I'm just going to mention really talk about our performance. And these are, after all, fees, and these are as of the end of August, and so they're fairly live and close to our time frame here. The first just gives us our overall book of business at ROCKLINC. So over the last year, we're up about 16.9, almost 17%, and over the last 3 years, we've been compounding at per year at about 12.3% a year. In the last 5 years, about 11%. And then the last performance slide I'll give you, if you just look at our equities. So if you just segment out our equities and you say, how did the ROCKLINC equities do relative to the TSX, the big Toronto market, or the S&P 500? And these are the total return indexes. So these include, dividends reinvested. Basically, as you can look at that yourself, you can see that we've outperformed those indexes pretty consistently. And we have a mix of Canadian and US stocks. And we've been ahead of the indexes consistently for the last 5 years plus. So we're very pleased with that performance. We don't sell performance. We're trying to sell philosophy and sell the way we invest in businesses. But we hope the performance, of course, over time will result in some great numbers. So at this point, I'm going to stop sharing the screen. I'm going to turn it back over to Jesse, and he is going to give you some highlights in terms of Wheaton Precious Metals. Jesse, over to you, sir.
Perfect. Thank you, Jonathan. As Jonathan mentioned, I'll focus on Wheaton Precious Metals, which is actually ROCKLINC's largest holding. We've picked the business up over the years. Over the past several years, it's oscillated around the same price range, but now we're really seeing a breakout, and it is our largest holding, so it's important to highlight. They pioneered the streaming business back in 2005, so we hold a number of streaming and royalty companies. Wheaton was the first one, primarily in the streaming business. And we've talked about these businesses before. We have Franco, we have Sandstorm, Royal Gold, Wheaton. So I'm not going to belabor some points that we have made over time, except to say these are businesses that produce massive cash flows that are relying on or dependent on a really great scalable business model. And there's large upside optionality from both price expansion in the price of gold and the underlying precious metal, gold, silver, and some base metals. And then just organic expansion of the mines. These companies can benefit from organic mine activity. If there's new discovery at the mine and so forth, a company like Wheaton will benefit. And they do not have to outlay an extra cent, and they get to benefit. So there's tremendous operating leverage and scalability in the business. And you see the scalability when on the slide there, you see that Wheaton's SG&A, or their expenses, equate to about 0.38% of their total enterprise value. Enterprise value just meaning their equity and debt values, so the total value of the business in that sense, and it's 3.38%. So that equates to the most comparable ETF that might be out there that has exposure to precious metals, whereas you get to hold Wheaton, which has an excellent management team, exposure to many different mines because it's a provider of capital to miners. And we will see that it's performed better than some comparable ETFs. So that's important to know, and that really highlights the strength of the business model. Wheaton itself, will focus on Wheaton itself, and it has 23 streaming agreements across 17 miners. And these include the biggest miners in the world, including Vale and Newmont Goldcorp and First Majestic. So they have exposure to great high quality miners, or tier one as they're known, with deep pockets that are able to invest in the mines. And Wheaton is a partner with them. And they benefit, like I said, in various ways, including they have great exposure to the underlying price of gold, and then organic expansion at the mine without the downside operational risk. Some few figures. Wheaton has invested $9 billion in deals since inception, has harvested over $7 billion, and there's more coming. But so far it's harvested or generated $7 billion of cash flows. It has a 40-year remaining weighted life of its reserves. Now, it doesn't own the mine directly, but the mines that it has streaming arrangements on or royalty deals on, that's around 40 years of remaining life. So there's a long runway. And that's just currently. That, like I said, that doesn't include organic expansion at these mines, which might increase that life. And then lastly, it's returned around a 17.5 compound annual growth rate per year since inception, which is, of course, fantastic. And it really, again, highlights the strength of this model. I'm going to now throw up on the screen the next few slides, which I have a few graphics here, which is going to be helpful to see. So I'll throw this up here. And this first graph here, you see the leverage, or beta, as it's known, to the price of gold. So as we know, around 2008 to 2012, that the price of gold really increased quite substantially. And you can see the excess cash flow versus the management's original guide that was generated. So here you just see the cash that's generated from the leverage to the price of gold, which is great. And then the second point that I would highlight, which is not so obvious, but even though the price of gold, it did take a dip from around 2012 to 2016, you see the actual business, the management was making deals during this whole time and increasing their cash flows. So in a way, they do benefit from the increase of price of gold, obviously, but then you can see they're growing cash flows even during periods of volatility in that price. So that's the powerful nature of the business, and it provides much more value than an ETF in that way, and also just holding gold. Wheaton has a leveraged beta to the price of gold, which is great. Looking at the business itself, more in terms of its portfolio, we see Wheaton has quite the substantial exposure to silver. It was formerly known as Silver Wheaton, but over the years, it has grown its exposure to now a majority of gold. And that's why it's renamed itself as Wheaton Precious Metals instead of Silver Wheaton, because now its portfolio has expanded, which is great. It has a diversification of metals. And it also has, on the right, you see there, diversification in terms of geography, which is great because the reduction of jurisdictional risk. through this geographical diversification is highly preferable. And all our royalty and streaming companies do have these diverse portfolios. And again, that just reduces risk to any specific one jurisdiction. Moving on to the next slide, we're going to talk about some recent catalysts for Wheaton Precious Metals. And the first one is quite general to all the royalty and streaming companies. The last two are more specific to Wheaton. As we know, the price of gold has advanced quite substantially this year. It's advanced 28% so far. And what's interesting to note is we compare Wheaton to the price of gold, silver, and two popular ETFs and indexes. So we see that Wheaton has outperformed all of these over the 1, 3, 5, and 10-year time horizons. So this is where active management really does provide a lot of value, and we see it right in front of our noses. And that's because this business is managed by a really shrewd management team. They just don't sit around. They're actively looking for deals. They make deals at the bottom of the cycle, and the IRRs that they generate are quite substantial. So we see this outperformance in Wheaton as a business. Two more catalysts for Wheaton Precious Metals. For years, there was an overhang of a tax ruling against them from the CRA. Not to get into tax law, but the CRA was contending that income earned from some foreign subsidiaries should be taxable in Canada. Now, in accordance with the tax law, without getting too deep, it was proven to see that by and large, Wheaton was following legal and acceptable practices. There were some minor adjustments that they made, but by and large, they were following the law. So with this overhang gone, that was one of the key catalysts that really saw the stock price advance, in addition to the gold price advancement in itself. So the years that we were picking away at the stock, it's nice to see the stock price really advance. And like I said, it is ROCKLINC's main holding currently. Salobo Mine. So Wheaton's largest exposure in terms of net asset value is Salobo Mine, which is mined by Vale. It is the largest copper deposit ever discovered in Brazil, and they began operations at this mine in 2012. This mine is considered to be an example of an iron oxide copper gold deposit. Just how the earth is created, a lot of metals are found together, and in this case, copper and gold, which is great because copper in itself, in terms of speaking about renewable energy, copper is a key component of various elements in the renewable energy space. So we have exposure to copper, and of course, our desired exposure to precious metals in light of some monetary experiments that has been going on for some time. So Salobo, like I said, is Wheaton's largest streaming asset. It's entitled to 75% of gold production. And the reason I bring Salobo up is that this, again, highlights the organic expansion that occurs at high quality mines. And currently at the mine, they are undergoing a 50% expansion in terms of throughput. So they're investing in the mine, and Wheaton is able to benefit from that investment and harvest future cash flows, which, as we see by the mineral deposit there, is very high quality. So these reasons and some more are some of why we like businesses like Wheaton, along with the other royalty and streaming deals, and we continue to add prudently and typically on when shares fall back. But these reasons are a good overview of our largest holding, Wheaton Precious Metals. I'll turn it over now to Andrew, and he will go over CGI.
That's great. Thanks so much, Jesse. As we've already talked throughout this presentation, technology in the sector has become extremely overvalued. And within this space, we find that there is one company that we believe is relatively attractive and has great growth prospects. And that company is CGI Group. I'm just going to jump straight to my presentation, and we can discuss further about CGI. So CGI is one of the leading information technology and business consulting service firms in the world. Now, technology is continually evolving, and it's advancing at such a rapid pace that companies and governments face great pressure to keep up and not get left behind. Companies and governments are finding that systems and processes are outdated. They're vulnerable to cyber attacks, and they're sometimes lacking innovation. And so that's where CGI comes in. They come in and fill in the gap by delivering solutions across the entire technology spectrum. These solutions extend from everyday mission-critical IT operations and business functions to large digital transformation projects across the entire enterprise. CGI has developed, over the course of the company's history, 175 intellectual property software and business solutions. CGI works directly with its clients, defines solutions to the customer's problems, and they package these solutions as commercial intellectual property, in which they use this and roll it out to other clients within the industry that might be facing similar issues. And so the benefit of this is that you have a software product that can be deployed across many different clients, and you also get a margin upside from having a software offering. Now, clients of CGI can have their technology and innovation accelerated because CGI invests in new technology, such as blockchain, cybersecurity, Internet of Things, artificial intelligence, and automation. So CGI helps propel its customers where, if based on their own in-house ability, they would not be able to. CGI is based in our next door in Montreal, Quebec. Has global offices across 400 locations in Europe, the US, Australia, and Asia Pacific. CGI has a global delivery network of over 77,500 consultants and professionals that have core expertise across 10 industries. So these consultants and professionals are not just experts in IT, but they also have expertise in their own respective industry. And so this is very beneficial for CGI's clients, is that they'll be able to amalgamate both the IT, but also the industry experience to be able to help their clients address their industry-specific problems. I've listed out just a couple of sample customers that CGI works with, just to get a sense of the breadth and size of its business. Over 500 financial institutions across the world, and that's including 15 of the top 20 global banks, depend on CGI to empower their payments, global trade, and wealth management platforms. Over 2,000 government clients across 28 countries rely on CGI to protect and manage their systems. Over 700 manufacturing clients choose CGI to power their smart factories and automate operations. Over 250 water, electricity, downstream clients trust CGI to provide real-time monitoring, controls, and analytics of their operation. And over 800 retail and consumer clients can accelerate their digital transformation, IT modernization by partnering with CGI. On the next slide, I'm just going to touch on just the investment rationale of the reasons why we see CGI as a profitable investment. So CGI is at the forefront of many long-term technology growth trends. CGI invests in a wide range of technologies, which gives us exposure to a basket of different technology solutions. Digital transformation, IT modernization, and cybersecurity have become top priorities for industry executives. And much of the technology budgets are moving towards in these three specific areas. Over the COVID period of restriction, many industries have pivoted towards having their employees working from home. And companies are seeing just the lack and the gaps of technology capabilities that they have and how much they need to be able to ramp up their technology to be able to remain competitive against competitors. Companies will continually, perpetually require new technology. And CGI is vendor agnostic and can work with many different types of technology vendors with their clients, which gives them a benefit over a specific technology company that only provides their one offering. Cybersecurity is also a growing issue across all industries, and companies and governments rely on CGI to protect their systems and operations from cyber attacks. Another factor that helps keep CGI stand apart from its competitors is that it has a global scale and depth of industry expertise that covers across customers' operational footprint. So CGI has large-scale clients with expertise across various different industries. And global enterprises have operations across the entire world, and they require a partner that has a global footprint that can be able to address their specific issues within their industry. And so CGI provides this expertise, and this gives us diversification and insulation against industry downturns. So we have seen throughout the COVID downturn that companies that have been able to withstand large downswings actually have diversified businesses that can help prop up other struggling portfolios in the business. So it's very important, and that's one of the reasons why we like CGI, is that it does cover across various different industries. And so if there is a downturn, the exposure that we get can be mitigated by other industries that it provides services to. And then the last reason why we like CGI is that it has a successful build and buy growth model. So the management team, they prudently deploy their capital for growth through making strategic tuck-in acquisitions, but also large transformational acquisitions that can help give them a footprint into an emerging area of the business. And all the while, they're winning and extending large contracts with new and existing clients. The contracts that they have are long-term in nature and are usually more than 5 years in length. So we have this nice recurring revenue stream. And so this has all resulted in a healthy return on invested capital of over 14% and free cash flow growth over a period of 10 years on average of 9%. And so we see that with CGI, it has its fingerprints in so many different areas within technology. We see that the investments that they're making are producing good returns, and they are generating a good free cash flow growth, which is what we like in a business. Now, on my last slide, I'm just going to walk through just a valuation. Now, we've been talking about different valuation methods of EV to EBITDA. One method that is frequently used in the industry is the discounted cash flow model. And this model, the theory behind it is that the present value of a company is based on the future cash flow projections that the company can produce, discounted to the present. And that's how you get the present value of a company. And so in this slide here, I just have a very simple model. It uses 10 years of cash flow, a growth. I have 3 types of growth rates. One growth rate is 3.5%. The medium growth is 5%. And then the high growth is 8%. So over the course of 10 years, the assumption that I have is that free cash flow grows at these growth rates for 10 years. After that 10 years, I assume that the growth rate grows for 1.5%. And so placing these numbers into our model, I generate the prices that we see here for the stock. So at 3.5% growth rate, you see a stock price of $102. At 5%, you see a stock price of $114. And then at 8%, you see a stock return of 143%. And so what I did on the far right column is I compared that to the closing price of CGI, the Canadian price, as at September 11th. And so you see that there is a discount of the valuation that I calculated for CGI based on those different growth rates compared to the price that it's trading at. And you see that 3.5%, which is very reasonable, because CGI over the course of 10 years, as you saw on my previous slide, has been compounding growth of free cash flow at 9%. And so 3.5% is very reasonable for a company such as CGI in the different areas that it's in. And so given the prospects and the growth opportunities that CGI has, we do believe that this is a company that is fairly valued to undervalued. And we don't believe that this is what many investors call a value trap, meaning that there's a reason why a stock is trading at a low multiple or a low valuation is because there's not much growth opportunities in the future. We do foresee that given the increasing trends of technology adoption and just the rapid pace of new emerging technologies that occur, companies will continue to perpetually require these type of services to remain competitive in this dynamic environment. And so for these many reasons, this is why we believe that CGI is a good long-term investment holding for our clients. I'm now just going to pass the screen over to Jonathan for his closing remarks.
Great. Thank you very much, Andrew. And just a couple, I just want to ask one question of Jesse, and then I want to just follow up quickly with one question for you, Andrew, in terms of this. So Jesse, in terms of Wheaton Precious Metals, and we've been looking at these companies, with the price of silver and gold substantially higher now than they were even in the second quarter and first quarter, a lot of the companies are expected to pay more in dividends. So maybe just mention a little bit about Wheaton Precious Metals' dividend policy, because our expectations is as the prices go up, clients not only should get growth, but Wheaton should also increase some dividends in terms of.
Yeah, Wheaton is actually rather unique, but they actually pay out 30% of their operating cash flow as dividend. They do this, and they do it to be prudent in a way, to manage their cash flows. Sometimes in yesteryear, gold companies, what they used to do, they used to pay out, increase their dividends when the gold price was going up, and then especially the miners, really, I'm talking about, and then they have this big, fat, juicy dividend, and they have to slash it, because mining can be CapEx intensive and so forth. But what Wheaton does is 30% of their operating cash flow, they'll pay out as a dividend. So they do have a minimum of 10 cents per share per annum, but they like to peg it, so they manage it with their cash flows. We saw a report this morning, actually. You sent a report, and now we're with a higher gold price. We could see a lot of these mining companies do increase their dividends, which could be an interesting avenue for shareholders to get a return of the capital. But yes, Wheaton does have a unique dividend policy.
Yeah, we would look to many of the companies that we have in that space actually as the dividends increasing fairly substantially over the next little while, which is going to be a great hedge to some of the risks. So we're excited about that too. And then Andrew, just one quick question: what changed, or did anything change given the lockdowns to sort of CGI's business model? I mean, some of the tech companies, I know, like obviously Amazon, everybody's buying on Amazon, so it took off it's taken off like a rocket, and people are getting used to that. Other companies, a little more ups and downs and things like that. So I know with the case of CGI, they've been doing very well and adding to their book, their backlog and their business. But there's been some changes and nuances. Maybe clients would be interested in how the lockdowns would impact a business like CGI in terms of sort of the size of contracts that they were doing, and things like that, but still growing.
Sure. Yeah. So initially, with the lockdown, when the lockdown started, companies initially halted, and they wanted to make sure that what they had in place was able to continue with the operations. As they were able to see that there's many gaps in their technology, they started ramping up the contracts and in terms of the length of the contracts. And the digital transformation projects that they're working on before, there was a bit of a pause, and the focus was just being able to operate within the COVID environment. Now that companies are able to see that they can operate, they want to expand into different areas that they did not have the expertise in before. And so the CGI has been getting great bookings because of this trend. Companies are increasingly seeing that there's so many different gaps within their technology, and that they do need this type of expertise from companies like CGI.
Okay, interesting. Yeah, no, it's fascinating because, of course, when you've gone through this lockdown situation, none of us have lived through something like this before. And so we're always watching the business model and how it's going to withstand it. And fortunately, we've been really blessed with a group of companies that have been very resilient, and in some cases have had opportunities to expand the size of the business and actually grow. And you can see that in your portfolios and some of the performance. Because when this first hit, of course, we were all over all of our companies trying to figure out what's going to happen here and how's that going to impact this business. And it's been an interesting sort of 6 months. But we appreciate all of our clients, your support. And we're working hard. We're adding to our team and continuing to look forward as we push through to the end of 2020. But I just wanted to emphasize, we are really focusing on the business model and on the business valuation. Things are not cheap in certain areas of the market, and we want to be very careful. And there's a lot of things that could derail the market also. So that's our update and our webcast for September. And our next webcast will be looking at probably December the 10th, if you can believe it. And again, we wish you all the very best. And if you have any questions, you can email, call us, and we will, of course, be in constant contact with each of you. Thank you very much. Bye now.